In this week's video, we'll show why it's fair to say the odds are improving for stocks, but hurdles remain. We'll cover numerous charts and risk-on, risk-off ratios in this week's video, but the meat of the video will be a summary table that shows the differences between the observable evidence on Monday and the close on Friday. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. We'll use this chart to explain some basic concepts and then apply them to the charts that follow so we can move along in a rapid manner. This is the ratio of stocks versus bonds in black. When the ratio is rising, it tells us that the demand for growth-oriented stocks is greater than the demand for defensive-oriented bonds. This is what risk-on looks like. The odds of good things happening in the stock market are higher when we have a risk-on environment. The mirror image of it is risk-off, and the probability of bad things happening in the stock market increases. When our ratio is above both the blue and the red moving averages and the slopes of the moving averages are up and blue is above red, that's a full bore bullish look. The mirror image is a full bore bearish look from a probabilistic perspective. As of the close on Friday, February 7th, 2014, we do see some improvement in that the ratio is now rising, but we still have a full bore bearish look. The improvement needs to morph into a look more like this, where the odds will then have shifted into our favor. These are three of the charts used in the CCM correlation model, which is one of the sub-models that feeds into the master market model. You can see on a weekly basis, we still have a risk-off look here for the S&P 500, but we do see some improvement with the ratio now very, very close to the blue moving average. Again, we would prefer to see this look here morph into a look more like this. Our stock versus bond chart up close, and the NASDAQ looks the best out of any of the major indices, where blue is still above red and prices basically sitting on them, giving it the highest probability of shifting back to a full bore bullish look. The correlation model answers questions, binary yes or no questions about all of these charts, and it also asks questions about indicators tied to the charts. We use custom moving averages for each chart because the volatility characteristics vary from chart to chart and ratio to ratio, and we also use custom settings for all of the indicators that we ask questions about. These charts go further down, but this just gives you an idea of how the model works. How much improvement did we see from Monday's low on February 3rd until the close on Friday, February 7th? Well, this table will help us answer that question. This is from the correlation model. There are 5 sub-models that feed into the master market model to help us answer the question, what's a prudent allocation into growth assets such as stocks, and a prudent allocation for conservative assets such as bonds based upon the market's current profile. The correlation model asks questions about all of these charts. We just showed you an example of the S&P 500 on the previous slide. In an oversimplified format, as of the close on Monday, roughly 8% of the answers to the questions and items tracked by the model were returning a bullish response. That's not very impressive considering this is scaled from 0 to 100. We did see improvement between the 3rd and the 7th from roughly about 8% returning bullish to roughly 24%. But at 24%, and the look of the previous charts that we just looked at tells us that we still have work to do. The odds really hit the sweet spot when this number gets closer to 50 and starts to rise above 50. Why did we add to our stock exposure before the close on Friday? The observable evidence has improved, which warrants an additional exposure to risk assets in an incremental fashion. If we felt that we were out of the woods, we would just take all of our money and place it into stocks. That's not where we are now, and this 24 tells us that there's still a high probability of weakness resurfacing in the weeks ahead. The more we see on the observable evidence front, the more confident we are that the rally will continue, and that will enable us to continue to scale in an incremental manner. Since a picture is worth 1,000 words, we'll go through 3 more charts. These are 3 charts tracked by the correlation model that we just looked at, and the answers to these questions were in the summary table that we just looked at. The triple Qs, or tech stocks, have regained a full-bore bullish look, but not in a confident manner. Even a relatively small reversal could change that profile. The credit markets here, JNK divided by TLT, improving, but they have work to do to get to a look like this. Would I rather be in small caps? Or would I rather be in TLT long-term treasuries? As of the close on Friday, February 7th, the answer was still I'd prefer to be in TLT rather than IWM. So this is another chart that has work to do before our confidence increases incrementally. This is a weekly chart of the VIX that we've shown on Twitter numerous times. This is the VIX here. These are moving averages that we use to track the VIX, and this is the S&P 500 up here for illustrative purposes only. This chart is telling us to keep an open mind from both a bullish and a bearish perspective. The glass half full. When the VIX hit the pink line here and the pink line acted as resistance, stocks up here rallied. Hit the pink line here, gains in the stock market followed. We bounced off the same pink trend line last week, telling us to keep an open mind about bullish outcomes. From a bearish perspective, we have the slope of the moving averages. This is decreasing fear here in teal. This is unsure relative to this. This is telling us that concerns from a slope perspective are increasing. We also have the VIX, or fear, now spiking above the blue line. We never moved above line A here, here, or here. We broke above it here, here, and here, telling us again that concerns are increasing. The longer the VIX stays below the blue and the pink and the green line, the better it is for the bulls. If it moves back up into this area here, and especially if we see a weekly close here or here, that's good news for the bears. Either in last week's video or the week before, we showed this breadth chart. This is new highs versus new lows here. This is the S&P 500 here. We noted when we see red or concerns on the breadth front that the probability of bad things happening increase in the stock market. This is observable evidence. Last week, this was red as of the close on February 7th. It is now black again, which increases the odds now of good things happening. Checking in our weekly momentum on the S&P 500, those of you that watch our videos know that when Williams %R, our weekly momentum, stays in overbought territory, the probability of good things happening increases in the stock market. And conversely, when we drop out of overbought territory from a momentum perspective, on a weekly closing basis, the probability of bad things happening increases. You can see here, when things get really, really ugly, once momentum dropped out, it never had an up week until after it hit oversold territory. Never an up week here, bad things happen. Never an up week in this bad period here, bad things happen in the stock market. That's not what we have now. We've already righted ourselves, so you can make an argument that this already looks better than this and this, where really bad things happened. The longer this continues to rise and the higher it gets, the better the odds in terms of shifting back towards the bullish end of the spectrum. You can see when things get really bad, we make it into oversold territory. Stocks are weak. Oversold territory, stocks are weak. Oversold territory, stocks are weak. When momentum stays above oversold territory, and if we continue to see that going forward, it increases the odds of good things happening. Reversal, good things happen. This is a daily chart of the S&P 500, one of many charts used in the CCM market model. It does a good job of summing up what we see today. 200-day moving average with a bullish and positive slope tells us that the long-term trend is still unequivocally bullish. The short-term trend recently started to roll over. This is the 50-day moving average, but we're seeing some improvement now. Instead of being negative, it was flat as of the close on Friday, February 7th. The bulls want it to morph into a look like this, where the slope turns up and price is above it, and the probability of good things happening will increase. The bears want price to get rejected in this area and move in this direction and see the 50-day moving average roll over in a bearish manner. We don't need to know what's going to happen next. We've seen some incremental improvement. If it continues to improve, we'll move towards the stock side of the equation. If it reverses, we may go the other way. We'll close out this week's video with the Master CCM market model. The model recommends a prudent exposure to risk assets and conservative assets. You can see as of Monday, the 3rd, it was at 31% risk, 69% conservative. We've seen incremental improvement. The close on Friday was at 47% risk and 53% conservative. Your needs and risk tolerance may vary. We use this as a guide for our clients. This is still roughly at 50-50, telling us that we still have a mixed bag. What we know is the profile is a little bit better than it was on the 3rd, but by no means are we out of the woods yet. The model will continue to look at the observable evidence and will make adjustments going forward in either direction, maintaining a flexible and open mind. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the Master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currency, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shivako Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.